Hi everyone, my name is Daniela Alvarado and I am Golden One Credit Union's Community and Financial Education Specialist. Welcome to today's session, Banking Basics. Our team is dedicated to enhancing the financial well-being of all Californians by offering valuable educational opportunities and complementary resources to the communities we serve. Our engaging resources encompass podcasts, videos, a thought-provoking blog, and webcasts. We have also developed an all-encompassing financial education learning platform called the Learning Lab. This invaluable resource hub is packed with information, enabling you to enhance your financial literacy and refine your skills on a wide range of topics. We'll be breaking down this workshop by starting with discussing the difference between banks and credit unions, followed by talking about all things savings and checking accounts, and then we'll finish off by touching on online and mobile banking. Let's start by testing our knowledge. Is a credit union, another word for a bank, a place to go get credits, or a financial co-op owned and operated by its members? If you answered C, then you're right. Credit unions are financial co-ops owned and operated by members. Both institutions offer a wide range of financial products and services to cater to their customers' needs. From basic banking services like checking and savings accounts to loans and investment options, you'll find these offerings in both banks and credit unions. Moreover, both provide the same level of federal insurance on your money. The primary distinction lies in their clientele. Banks have customers just like any other business who can access their services without any formal membership requirements. On the other hand, credit unions have members who share a common bond, such as being part of the same community or working for the same employer. With Golden One, for example, in order to be a member, you need to work or reside in the state of California. Let's explore the ownership aspect. Banks are typically owned by shareholders, and as such, they operate as for-profit entities. These shareholders expect a return on their investments, and profit maximization is a significant goal for banks. Credit unions, however, operate as not-for-profit institutions. Their ownership belongs to the members themselves, who have an equal say in decision-making. This setup ensures that the credit union's operations align with the best interests of its members. Credit unions act as not-for-profit financial cooperatives. What this essentially means is that any profits we generate are reinvested back into the communities we serve. By channeling these profits, credit unions can offer their members various benefits, including lower fees, more competitive loan rates, and higher savings rates. This surplus also allows us to actively contribute to the community by offering scholarships, grants, and valuable financial education workshops. As a member of a credit union, you have a say in its operations. Your voice matters, and your vote counts when it comes to shaping the credit union's future. Credit unions tend to have strong local ties and are deeply rooted in the communities they serve. While different credit unions may have specific membership criteria, we are all part of a larger co-op network, ensuring that our members can access their accounts nationwide through co-op ATMs. Credit unions are a one-stop shop for a wide range of financial products and services. You can find all the essentials you'd typically expect from a bank, such as savings and checking accounts, retirement options and loans, but with the added benefit of personalized service and community-focused values. When banking with credit unions, consumers can rest assured knowing that their money is secure, thanks to the National Credit Union Administration, or NCUA, which is an independent agency of the U.S. government. The NCUA was established in the 1970s by Congress. Its primary role is to regulate federal credit unions and ensure their financial stability. The NCUA requires federally insured credit unions to display their insured status in advertising, branches, and offices. If you see the NCUA insured sign, your deposits are protected within the federally designated limit. In the event of a credit union's closure, the NCUA insurance coverage allows credit union members to recoup up to $250,000 per qualifying account. These accounts include savings, checking, money market accounts, and share certificates. For individuals with more than $250,000 at a single credit union, there may be additional insurance coverage available, such as adding joint owners, beneficiaries, or having additional share accounts. This added protection gives peace of mind to those who have larger deposits, as they can enjoy extended coverage beyond the standard limit. Let's dive into the world of savings accounts and explore how they serve as a vital tool for securing your financial future. Savings accounts serve as a secure place to keep your money for future needs and financial goals. Both banks and credit unions utilize the money deposited in savings accounts to provide loans. As an incentive for members to keep money in savings, both institutions offer interest on the balances. One significant advantage of having a savings account is the ability to separate your funds from everyday spending. This separation helps in establishing and working towards financial goals. The interest accrued in your savings account can play a pivotal role in helping your money grow over time, especially when you maintain your savings for an extended duration. The compounding effect of interest can substantially boost your savings balances. There is a wide array of savings accounts options available in various financial institutions. Today, we will focus on three primary types commonly found in most establishments, and those are savings accounts, share certificates, and retirement accounts. The standard savings account is a common offering in most financial institutions. It provides easy access to your funds, allowing you to deposit and withdraw money without incurring penalties. These accounts typically have low to no fees and offer limited interest. Apart from the standard savings account, there are specialized options like holiday savings accounts and other special event savings, which allow you to set funds aside for future purchases, such as a car, for example, with the flexibility to deposit throughout the year and withdraw only on a chosen due date. Youth savings accounts are also prevalent, providing an excellent way for parents to deposit birthday or holiday checks for their children. These accounts not only secure funds, but also introduce children to the benefits of banking from an early age. Consider share certificates as a contractual agreement with your bank. By depositing a predetermined sum for a specific duration, you gain the benefit of higher interest rates compared to standard savings accounts. This contract ensures that you are rewarded with guaranteed returns for keeping your funds in the account for the agreed upon time. However, it's important to note that entering into this agreement entails early withdrawal penalties if you close the account or withdraw funds before the maturity date. Despite this, many individuals find share certificates appealing due to their secure and risk-free nature, providing a safe investment option. Moreover, share certificates offer flexible term choices, typically ranging from 3 months to 5 years, allowing you to select a duration that best aligns with your financial goals. There are three common types of retirement accounts offered by banks and employers: 401ks, traditional IRAs, and Roth IRAs. 401ks are retirement plans sponsored by employers, with contributions deducted pre-tax from your paycheck. Some employers may also offer 401k match programs, matching a percentage of your contributions. Additionally, 401ks allow you to take loans against your retirement balance. Traditional IRAs are retirement accounts that offer tax-deductible contributions, which can help lower your taxable income. With traditional IRAs, you enjoy tax-deferred growth and taxes are paid upon withdrawal. Roth IRAs are another retirement option available through banks and credit unions. With Roth IRAs, contributions are made using after-tax dollars, allowing you to withdraw your contributions at any time without additional taxes. Saving money and having a dedicated savings account creates a safety net for you and your family. Life is unpredictable, and unexpected emergencies or expenses can arise at any moment. Having savings allows you to face these situations with greater confidence, knowing that you have the funds set aside to handle them. Knowing that you have a savings account to rely on in times of need can significantly reduce financial stress. Instead of worrying about how to cover unforeseen expenses, you can focus on addressing the situation at hand, knowing that you have a backup fund. While the interest you earn in a savings account may seem small initially, over time it can contribute to significant growth in your account balance. Having substantial savings empowers you to be more financially independent. It allows you to avoid unnecessary debt and reduces the need to rely on credit cards or loans to cover unexpected expenses. In conclusion, saving money and having a savings account offers multiple advantages beyond just the financial aspect. It provides security, freedom, and the potential for growth, ultimately contributing to a more stable and fulfilling financial life. A checking account is a convenient service offered by financial institutions, allowing you to deposit funds and withdraw them at your convenience. While checking accounts generally don't earn interest, they do provide easy access to your money, and there's typically no limit on the number of withdrawals you can make in a month. Some people avoid opening checking accounts due to concerns about the safety of their funds in the event of their financial institution's closure. Instead, they resort to using check cashing stores and carrying large amounts of cash, which is not advisable. Check cashing places charge steep fees, and unlike a lost or stolen debit card, lost or stolen cash cannot be replaced. However, keeping your money in a financial institution, specifically in a checking account at a bank or a credit union, is the safest option. These accounts are insured, ensuring that you won't lose your money in the event of any unforeseen circumstances. Like savings accounts, there are also a lot of options for checking accounts, but today we'll only be covering 3 commonly found products offered by most banks and credit unions. And those are your standard checking accounts, high yield checking accounts, and business checking accounts. One of the most appealing aspects of a checking account, especially one with a credit union, is the low to no fees associated with it. Your standard checking account typically won't have any minimum balance requirements or low to no minimum account opening deposits. A checking account also ensures convenient access to your funds whenever you need them. With a vast network of ATMs and shared branches, you can withdraw cash or check your balance with ease. Bill payment is a convenient service where you can set up recurring payments for bills, such as utilities, rent, and more, eliminating the hassle of writing checks or visiting multiple payment centers. Another valuable feature of credit union checking accounts is overdraft protection. This service helps prevent overdrawing your account by linking it to a savings account or line of credit. If you accidentally spend more than your available balance, the credit union will transfer the difference, sparing you from costly overdraft fees. Opting for direct deposit with a checking account offers added convenience. Your paycheck, government benefits, or other income sources can be deposited directly into your account, ensuring timely and seamless access to your funds. This removes the need to visit a branch on busy paydays to deposit your checks manually. Also, when you have direct deposit with a credit union, you can get your paycheck deposited up to 2 days earlier. High-yield checking accounts are designed to offer attractive interest rates and cater to members with substantial balances. They present unique advantages that can elevate your banking experience. The standout feature of a high-yield checking account is the significantly higher interest rates compared to standard checking accounts. With these accounts, your money can work harder for you, earning more substantial returns on your deposited funds. High-yield checking accounts are particularly beneficial for members who maintain significant balances in their checking accounts. If you tend to keep a substantial amount of money in your checking account regularly, a high-yield option rewards your diligent financial management with more substantial interest earnings. It's important to note, however, that high-yield checking accounts may come with specific fees and minimum balance requirements. These requirements are in place to ensure that the account remains eligible for the higher interest rates. While the fees and balance requirements may be higher than those of standard checking accounts, the potential to earn more significant interest can make these costs worthwhile for members who meet the criteria. Specifically designed to manage business finances, this account provides numerous advantages that facilitate smooth operations and financial organization for businesses of all sizes. A primary purpose of a business checking account is to streamline business finances. By keeping business funds separate from your personal finances, it becomes easier to track income, expenses, and overall cash flow related to your business. This separation not only simplifies accounting, but also safeguards personal assets from business liabilities, reducing financial risks and protecting your personal wealth. A dedicated checking account also provides a comprehensive record of business transactions, which makes accounting and tax reporting more efficient. With well-organized financial records, tax compliance becomes more manageable, potentially reducing stress and avoiding penalties during tax season. It's important to note that business checking accounts may involve fees and minimum balance requirements. These costs are associated with various services and benefits provided to businesses, such as business-specific customer support and enhanced security measures. While these fees and balance requirements may exist, the advantages of a business checking account, included improved financial management and credibility, often outweigh these costs. Now that we've covered the most commonly found bank account types, let's cover a bit of information on how to open an account with a credit union or a bank. Most people apply for a checking account in person at their local branch, although some financial institutions let you apply online. Since opening an account can take several minutes, only go when you have plenty of time and remember to bring identification and funds to deposit with you. If your application is approved, you'll receive your new account number, maybe a checkbook, and debit card. You should also be given a fee schedule. Be sure to read this carefully to understand what fees you could be charged. Now, unfortunately, not everyone who applies for a checking account is approved. One reason you may be denied is if you have a check systems report. Check systems collects information on negative checking and savings account activity and provides this information to other financial institutions. Negative activity includes writing fraudulent checks or committing other acts of fraud, bouncing checks, and overdrawing your account. There's no standard for reporting to check systems. Some financial institutions will report a check that bounced due to a miscalculation, where others may only report cases of fraud. A legal check is broken up to 11 different components, and each component plays a vital part in record keeping and ensuring its authenticity. Number 1 is the name of the owner of the check. This is the person who gave you the check or who is paying you for a service. Number 2 is the date the check is allowed to be negotiated. Personal checks have an expiration date of 6 months, and most paid checks follow the same rule unless otherwise stated on the check. State and federal checks are valid for up to 1 year from the date the check was written. Number 3 is the recipient, which is the person who is negotiating the check and depositing it into their account or cashing it. Number 4, this here is where the numerical amount of the check goes. Number 5 is the legal written amount, which is the amount that the check can legally be cashed for. It's important to ensure that both the numerical and written amount are the same, but if there are any discrepancies, the bank has to go by the legal written amount. Number 6, so all checks will also have the name of the financial institution from where it's drawn off of, usually right around here. Number 7 is the memo line. While not necessary to be filled out to be valid, it is a great tool for record keeping. Number 8 is the owner of the check. So this is where the owner of the check has to be the one to sign the front of the check. Without their signature, the check is not valid. Number 9 is the routing number, which is the identification number for the bank. It should always match up with the financial institution's name that is written on the front of the check. Number 10 is the account number, also known as the checking account number, from where the money is going to be withdrawn from. And lastly, number 11 is the check number, which can always be found in 2 different places. Once in the line of numbers found below of the check, and again at the top right corner of the check. Debit cards are the most common way that members use to access their checking account. Here we'll delve into some of the key components and security features. Debit cards are equipped with EMV chips. These chips generate unique transaction data for each purchase, making it extremely difficult for hackers to clone or replicate card information. This chip technology reduces the risk of card fraud and ensures safer transactions. The traditional magnetic strip on the back of debit cards used to be widely used for transactions. However, with the introduction of EMV chips, they are being gradually replaced. The magnetic strip contains essential account information, which allows it to be compatible with older payment terminals. Debit cards are linked to payment networks such as Visa, MasterCard, Discover, or American Express, allowing transactions to be processed and authorized by the issuing bank and the merchant's bank. These payment networks ensure seamless communication between various financial institutions, enabling quick and secure transactions worldwide. CVV numbers are also known as card verification codes and are a crucial security feature for online transactions. During online purchases, merchants require the CVV number to verify that the cardholder physically possesses the card, which adds an extra layer of security against unauthorized use. Many debit cards feature security holograms, which are unique reflective images applied to the card's surface. These holograms serve as an anti-counterfeiting measure, making it challenging for fraudsters to create fake cards. Credit union debit cards include an extra feature, an icon that signifies that it is part of a larger co-op network. This icon can be found on the back of a debit card and on ATMs that are a part of this network. This signifies that you can use any ATM with that icon without being charged any out-of-network ATM fees. Debit cards make it incredibly convenient to access your funds. You can make withdrawals at ATMs and purchases at stores and online. At many stores, when using your debit card for purchase, you'll be asked by the terminal whether you want to use debit or credit. It's important to know the difference between the two because your choice will impact how the transaction is processed. When selecting debit, you'll need to enter your personal identification number at the terminal. This option allows you to make purchases by directly accessing funds from your linked bank account. In some stores, when using the debit option for a purchase, you may have the additional benefit of getting cash back. Transactions made through the debit option are deducted immediately from your bank account. This means that the funds are instantly taken from your balance, providing real-time updates on your balances. Opting for credit when making a purchase with your debit card does not mean you're using a credit card. Instead, it processes the transaction through the credit card network, such as Visa or MasterCard. When choosing credit, you'll typically need to sign a receipt or the terminal to authorize the transaction. Some debit cards may not require a signature on smaller purchases, making the process a bit quicker. A significant advantage of using the credit option is that it may offer zero liability protection for fraudulent transactions. Unlike debit transactions, credit transactions take slightly longer to process. It's essential to note that even when choosing credit at the terminal, your debit card transactions do not contribute to building a credit history. Credit building is exclusive to credit cards and loans. There are also other ways to access funds from your checking account. Besides regular checks, you have the option of using cashier's checks and money orders. These are secure payment methods issued by financial institutions and other authorized entities. Electronic checks are a convenient and safe way to make payments online. By entering your account details and authorization, you can electronically transfer funds directly from your checking account to the payee. This method eliminates concerns about checks getting lost in the mail and reduces the time it takes for payments to be processed. Automatic debit is a hassle-free method for managing recurring payments. You can authorize service providers to automatically withdraw the required amount from your checking account at a predetermined time each month. Many financial institutions offer online bill pay services, providing a centralized platform for managing your bills. You can log into your account and input the payment amount for various service providers, lenders, or other payees. By utilizing the different options offered to you, you can effectively manage your finances and tailor your transactions to suit your specific needs and preferences. We've explored a lot of important banking features. I want to close this out by talking about possibly the most essential financial service, which brings banking straight to your fingertips. Mobile banking enables you to access your online banking account from your smartphone or tablet, providing you seamless connectivity 24/7 no matter where you are. With mobile banking, you can effortlessly view your balances in real time, ensuring you stay updated on your financial situation at all times. The platform also allows for convenient fund transfers between your accounts, making it very easy to manage your money. A powerful feature of mobile banking is the ability to deposit checks remotely. By using your smartphone's camera, you can capture an image of the check and submit it securely through the mobile app. Depending on the bank's policy and other factors, a temporary hold may be placed to ensure the check clears before the funds become fully available for use. I want you to imagine that you're reviewing your transactions through your online banking to total up your monthly spending. You determine that you have an extra $100 that you want to transfer from your checking account to your savings account. Well, online banking makes it incredibly easy to complete the transfer in just a few clicks. It's important to understand the difference between internal and external transfers. Internal transfers are when you transfer funds between accounts at the same financial institution, while external transfers are when you transfer funds between accounts that are not at the same financial institution. Internal transfers allow you to transfer money between your own accounts or yours and another account holder, while external transfers can only be completed between your own accounts. The other difference between the two is that with internal transfers, the funds are available immediately, while with external transfers, they're not. Staying aware of predatory practices and scams is essential for safeguarding our financial well-being and personal information. Stuff to look out for are things such as mail theft, which is a concerning tactic used by scammers to obtain sensitive information such as bank statements, credit card statements, and personal documents. Protect your mailbox by using secure mailboxes, promptly retrieving mail, and opting for paperless statements whenever possible. When using online marketplaces, exercise caution to avoid falling victim to scams involving counterfeit products, fake listings, or payment fraud. Verify sellers' credibility, read reviews, and use secure payment methods to minimize risks while shopping online. Check fraud can occur when scammers alter or forge checks, leading to unauthorized withdrawals from your account. Keep your checks in a secure place. Regularly review bank statements and report suspicious activity as soon as you see it. With advancing technology, scammers may use artificial intelligence to craft convincing phishing messages or create deepfake audio and video to deceive victims. Be skeptical of any unexpected communications, especially if they request sensitive information or money transfer requests. You can stay informed about fraudulent activities through FCC Fraud Alerts, which provides updates on prevalent scams and fraud tactics. Lastly, while payday loans aren't necessarily a scam, be cautious because they often come with high interest rates and aggressive collection practices. Explore other financial options such as credit unions or personal loans, which may offer more favorable terms. I want to conclude this workshop by leaving you with some tips on how to safeguard your financial information. Keep your debit card secure and never share your PIN with anyone. Memorize your PIN rather than writing it down, and avoid using easily guessable combinations. Store your checks in a safe place to prevent unauthorized access. Destroy old checks and financial documents securely by shredding them. Carry only the amount of cash you need for immediate expenses to minimize the risk of loss or theft. Shred financial documents, bank correspondence, and other sensitive mail before disposing of them to prevent identity theft. Be aware of your surroundings while entering your PIN at ATMs and other public places. Make sure that you're using unique passwords for your online and mobile banking profiles. Be cautious when you're using public Wi-Fi and only access sites that hold private information while you're using your cell phone's data plan. And lastly, don't provide account information via email, text messages, or direct messages. I want to thank you all for listening and want to leave you with one more resource. Our newly improved Learning Lab has a ton of online interactive learning tools that cover a wide range of topics, including a lot of what we discussed today. It's free to use, so make sure you check it out and continue learning.